Well, we're lucky because Jim Cramer was listening, and he did come down to join us on the set.
I always listen.
And I'm glad we had a chair here for you, because I really feel like this is one of those conversations after one of these pivotal weeks that we need to hear from you. What do you make, first of all, of Steve's assessment that, look, a lot of these stocks were punished too much, that they still have an overwhelmingly large competitive advantage, and now's the time? You might not time it perfectly, but why not today?
Okay. Look, I think the problem is you can never pretend that you know when you don't know.
Jim Cramer discusses Nvidia's position in the AI market and broader tech investment trends. He highlights concerns about regulatory clarity, export restrictions, and the risks of market concentration, noting the reliance of major companies like Microsoft, Apple, and Oracle on Nvidia's technology. Uncertainty around competitors and global dynamics adds complexity to Nvidia's growth outlook. Cramer underscores the macroeconomic impact of massive AI-driven capital expenditures, which have bolstered GDP growth but concentrated risks in a small sector of the economy. These investments must deliver productive returns to justify high valuations and sustain investor confidence. Finally, he sees recent stock valuation adjustments as healthy for the market, allowing investors to recalibrate risk and return expectations. While caution is warranted, Cramer remains optimistic about Nvidia's long-term potential if its growth aligns with evolving market realities.
And it's always gutsy to come out and say, listen, I don't know. I mean, look, right now, Jensen Huang's with the president. I would like to hear what he has to say. And we need, if you're long this stock, you need to hear that the president wants to undo what Biden did right at the end, which is to say, listen, we're only going to let them sell a lot to 18 friendly countries, which, by the way, they left off some major countries like Israel, which is supposed to be a friend as far as I know. I listened to Alex Karp earlier and say definitely, but lots of other countries that are in the EU. So we need to hear that reversed. You need to hear that the president doesn't fear that chips are going to go to China at the lower level. Remember, they were giving lesser chips to China, and that Nvidia has been able to convince him that there is no backdoor from Singapore. There isn't, because I think that they are able to account for all those. So let's go back to, and by the way, I know that Jensen Huang hates Moore's Law, thinks it's dead, but I think the biggest issue is you got through the hurdle of Meta saying they need it. We know that Oracle needs it without a problem. We absolutely got that. We know that Apple wants anything it can get, and they're a free rider. They'll be good. But we know that Microsoft needs more. But what we don't know is Amazon.
So I'll put this question to you. Should investors fear the news coming out of a DeepSeek?
I think that it's a shock, of course. And it's not just a market development. When we look at the U.S. economy over the last 2 years, and it's really remarkable resilience and strength in the face of high interest rates, it's mostly attributable to this boom in what you could call fixed industrial investment. Some of that, of course, is manufacturing reshoring. A lot of it is EVs, battery factories. But of course, we all know the biggest driver is AI spend. You have just four companies, and these are, of course, some of NVIDIA's biggest customers, that are intending to increase their capital budgets by 90% in 2025 relative to 2023. So you have just four companies combining to spend almost $300 billion this year. And again, this is now really significant from a macro perspective. These companies' capital budgets have gone, as a share of GDP, it's risen sixfold in the past several years. So again, this is not just about markets or about individual stocks. It has very significant macro significance. And the premise of this spending, number one, is that you need all these capital outlays to achieve your AI goals. And secondly, that this capital spending is going to be highly productive in that it's going to lead to applications, revenues, all these downstream use cases that are going to generate more than sufficient revenues to generate significant returns on all this incremental capital. And so this news, again, it's preliminary. I don't think it's, it doesn't make sense to overreact to it, but it does raise questions about whether, again, all this spending is necessary. And then secondly, whether the return on all that capital, if it's not, is going to meet investor expectations and essentially validate the very high valuations of many of these businesses that have been spending to such a large extent.
And listeners, an opening bid, I should note, I'm going to share Jason's chart on my X account at Brian Sozzi, and also LinkedIn at Brian Sozzi as well, because I think it really is interesting stuff. Jason, but do you think, I mean, you mentioned this was a shock. Do you think it's a warranted shock that investors need to get realistic with some of their expectations on future growth?
Yes, I think that, a lot of people, when they focus on Nvidia stock, they focus on in the 10Q disclosures, they demonstrate this concentration risk. That I think in the 2 quarters ago, it was 4 customers that accounted for 48% of revenues. The most recent quarterly filing, I think it was 3, accounting for 36%. So again, this sense of concentration risk is something that a lot of analysts have pointed out. But this is also, again, of course, a question of concentration risk for stock market investors more broadly. When you have, this handful of companies, 5 or 6, accounting for about 28% of total U.S. stock market capitalization. But again, what I'm also suggesting, and the reason that I'm more concerned, is because of the macro significance that you have a relatively small share of the economy that is accounting for an outsized share of the growth in GDP, again, because of how much they've been investing. So, this is an economy that's performed well, but I think we've seen in recent weeks, recent months, the compression of risk premia, and that's where I think we'll probably see now some widening, some just the discount rates applied to these future cash flows, applied to this growth expectations, that actually increase somewhat, just to get better compensated for the unknowns here. And the unknowns, I think, is again the potential for alternatives to some of the approaches that have taken with the generative and foundational AI models that could actually be much more efficient, that actually do not involve the same demand for compute and capacity. So again, we'll see, but to me, this is mostly about the price of risk and getting better compensated for what we don't know as far as what lies ahead with AI.
Well, Jason, you're a researcher. Then is the investment thesis for Nvidia, the longer term investment thesis for Nvidia, because of this one piece of news, do you need to toss that in the trash? 2 weeks ago, everybody loved Nvidia. They're going to grow X by X amount. They're valued at 35 times forward earnings. Their earnings are going to grow double digits for the foreseeable future. But do you just need to take it, throw it in the garbage, and totally rewrite how the company or how one thinks the company is going to grow?
No. Again, you can make your projections and you can have your best estimates about what's going to happen on the top line. The maintenance of these very wide margins. You can make your assumptions there about competition, and you should, again, I don't know how much things have changed on that front, but then you have the question of the valuation, and again, this is an issue of what is the expected return here, and how much are you getting compensated for the risk that your estimates, however well constructed and conceived, don't actually turn out to be the case. And that's where I think, just again, a rethinking of the price of some of these assets, not because you're fundamentally rewriting your forecasts, but just because you want a bit more compensation for, just the error bands, the range of potential outcomes.
Isn't it good that investors are being taught this lesson? Don't they need to be reminded sometimes, Jason, that stocks don't always go up in a straight line? I mean, sometimes these things happen, and it's healthy.
Absolutely, it's healthy, and that's how the expected returns increase, right? So the price falls today, valuations come down, and then the expected return, if those forecasts come to fruition, is actually higher as a consequence. So I think that's very important. When you have a company that is growing as rapidly, with expectations for earnings growth in that high as far as the eye can see, and it's priced to a return of maybe 7 to 10%, that there's a lot of risk there, and so I think, again, that this increased compensation for risk is very healthy, and eventually will draw more buyers in, of course.
Jim Cramer emphasizes Nvidia's pivotal role in AI, while highlighting risks such as U.S. export restrictions, reliance on key customers, and market concentration. He views recent valuation adjustments as a healthy recalibration, reflecting broader concerns about AI-driven spending and its impact on the economy. While AI investments promise transformative growth, questions remain about their productivity and ability to justify high valuations. The discussion also explores macroeconomic implications, noting that a few companies drive disproportionate growth in GDP through AI-related expenditures. Analysts call for greater risk compensation, suggesting that market corrections are essential for sustainable growth. This environment offers opportunities but demands careful risk assessment. Are recent market corrections a sign of healthy long-term growth for AI-driven companies? How should investors approach the concentration risks tied to Nvidia's business model?